Good morning and welcome to this Wednesday, May 17th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it is midweek. Options expire this Friday. This is the week I refer to as Opposite George Week. For those of you that are Seinfeld fans, you'll know exactly what I'm talking about. For those of you that are not Seinfeld fans, are not familiar with or at least not familiar with that episode, it's an episode where George Costanza, who is, always very pessimistic, always looking down on himself, thinks everybody else has everything, he has nothing. And he's sitting in the diner one day with Jerry Seinfeld, and there's an attractive woman walks in and is sitting up at the bar, and he makes some comment about, how his life is so horrible and, nothing's going right, blah, blah, blah. And so Jerry and Elaine, who are at the table, basically start saying, well, listen, George, if your life is horrible and you keep making all these wrong decisions, just start doing everything opposite. So he looks up and he's talking about how attractive this girl is at the bar and how she would never be interested in somebody like him. And they're like, hey, this is your chance, do something opposite. So he goes up, tells him he's unemployed, lives at home with his mom, blah, blah, blah. And, her response is, hey, you're cute. And so it was kind of a funny episode, just that everything he did, he tried to change everything in his life and things started picking up for him. And so I always equate options expiration week to kind of opposite George week. Everything that's been working heading into the week tends to struggle. And everything that's not been working all of a sudden seems to come back to life. And we haven't yet seen that this week. So it'll be interesting to see if that starts today. But we're going to talk a little bit about options expiration. We had a great event with our members last night. We do a Max Payne event, which deals with option expiration and which direction the market could go based on what we're seeing in the options world. And I'll give you a little taste of that in just a little bit during our chart of the day. But point is, we have to kind of be on guard this week. I'm bullish. I think everybody knows that. Anybody who's been listening to the show, I was bearish in 2022, first 6 months. That was it. I thought that was a cyclical bear market. I called it before it started. I called it when it ended. And I think we're in a bull market. And until I'm proven wrong, I'm going to stick with what I'm seeing in the charts, which tells me we're going higher. But options expiration is that one time each month where we got to be a little careful. There's a reason why the S&P 500 has performed so poorly over the years from the 19th to the 25th of all calendar months. And I believe it's because of options expiration. You have markets that go up, and then you go into option expiration week, opposite George week, and they come back down. And by coming back down, it's actually a windfall in profits for market makers. And when they have an opportunity to get a windfall in profits, I take notice, because they generally are going to make money when they have the opportunity. And they do it because of an unsuspecting public. Not a lot of people even understand Max Payne, understand options expiration and what that means to the stock market. It has no long-term consequences. So if you're buying and holding for the long term, doesn't matter. But if you're a short-term trader, it matters a ton, because usually what happens is the market goes up into option expiration week, and then we pause, consolidate, maybe even drop. And knowing that ahead of time gives you the opportunity to cash out, get into some cash, maybe even short if you want. But it's just a time to assess risk and understand that risk is higher. Anyway, we got a lot of that to go over, but let me go through first and let's talk about what happened on Tuesday. So it turned out to be a not so great day because of some selling right in the last 30 minutes of the day. We were, hanging in there doing pretty well, but things definitely got a little tight at the end of the day. A lot of selling taking place. And as a result, saw the NASDAQ give up its gains. It was up quite a bit on the day, or at least having a pretty decent day. It turned red. You can see the Dow Jones was down more than 1%. S&P 500 down almost 2/3 of 1%. The NASDAQ actually ended up finishing down 0.2% at 3:30 yesterday afternoon. Probably weren't thinking that, but There was some pretty good selling, which we'll talk about in just a bit. The mid caps lost 1.4%, small caps 1.3%. This is a group that showed a little bit of life on Monday, and then life came right out of them yesterday. Ended up going back down below those prior lows, or below the low for Monday. And now we're kind of stuck here. When you look at the mid caps, got recent lows around 2,400, but the big ones, I think, come in from the December low and then also the March low, and you can go back to the October low. But all of those give us a little bit of support down, probably closer to 23.25 to 23.50. But 2,400 short term is going to be some support. We're sitting at 24.16. Small caps closed at 11.16, 11.1677. You can see the recent low was down at about 1,100. So we've been in this downtrend. Do we go all the way back to 1,100? I don't know. The fact that it's opposite George week and we've been going down in small caps, I have a feeling we're going to see some money rotating into that area. I was starting to get into a little bit of a leveraged position yesterday. And then after we went back down yesterday morning and we saw the NASDAQ rallying throughout the day and small caps weren't, I decided just to, hey, let's move back a little bit more into cash and let's just watch the action. But I actually like small caps. I like mid caps. And the reason that I like them is I believe the overall market's going to go higher. And if you look at a long-term chart, mid caps and small caps are much closer to their support level on a long-term basis. And so that gives me a little bit more immediate hope that these two are probably going to turn around sooner rather than later. Whereas when you're looking at the NASDAQ right now, I mean, we're getting close to the August high. And that can be a problem because not only do we have overhead price resistance, but a lot of the stocks driving the NASDAQ to the upside are heavily in the money on the call side right now. The net in the money call premium on many of these large cap NASDAQ names, Microsoft, Amazon, Apple, NVIDIA. I mean, these are all names that have been going up quite a bit over the last month. And then as a result, we have a lot of in the money call premium on those stocks and very little in the money put premium. And that just skews things a little bit. And it kind of incentivizes market makers to possibly push prices lower. It's not a guarantee. When I look at Max Pain, I look at option expiration week. For me, it's part of my risk analysis. It's not part of a guarantee. So I've seen months where we look at Max Pain and says, yep, looks like we're going to probably pull back 2 or 3%. And we go up 2 or 3%. It's not a guarantee. If you're going to try and short some of these stocks, I would absolutely keep a stop in play. Would not want to get caught because, again, I think the market's going to go higher down the road. I think the rest of 2023, we're going up. So I don't want to be caught in short positions. Some of you might like the short side, might be bearish. That's fine. 2 sides to every market. Pick your side. I believe we're going higher. I've been saying it since June. We went back down, I think, in September and basically had an equal second bottom where we were in June. I said, hey, bottom 2.0. Beginning of October, we went down a little bit lower. I think the S&P, we had 5 lower closes on a daily basis before the run began to the upside. Value stocks led in the fourth quarter. Growth stocks have absolutely dominated in 2023. So I think we're going higher. But again, that's my opinion. Short term, though, we got options to deal with. And I think that's where some of this opposite George could come into play. We could see value start to move up while the more aggressive stocks pull back for a period of time. I wouldn't be surprised. I mean, I think the next week to 10 days could be a little dicey. Maybe the market takes off. Who knows? But I do think the risk, the short-term risk, has definitely increased with options expiration. From a sector perspective, the only group higher yesterday was technology, which is one of the aggressive groups. It did come down quite a bit in the last 30 minutes. I think it was only discretionary stocks that came down more in the last 30 minutes than technology. Actually, no, real estate did. Real estate was the number one. Anyway, we'll look at those charts in just a minute. But for the day, technology was the only sector to finish in positive territory. The other 10 groups all lost ground. And the interesting part is we had real estate, utilities, 2 defensive groups, energy and materials, 2 what I call neutral groups. That's where the selling primarily was. Notice you don't see discretionary, you don't see communication services, you don't even see financials and industrials, 2 more value-oriented sectors that tend to, move kind of a little bit more in lockstep with defensive groups. Not quite. They're not quite as defensive. They have a little bit, an element of aggressive nature. But there are a lot more value-oriented stocks in financials and industrials than there are, say, in technology, communication services, and discretionary. So anyway, it was not a great finish to the day. You can see real estate down 2 3/4%, breaking back down below these recent lows. Energy down almost 2.5%. I've said, once we broke down, I thought we had a reasonable chance to go back and test that March low. We're getting pretty close now, breaking down to new lows again. The utility group, big breakdown here. You see the PPO just crossing over into negative territory, not looking good there. And then materials also moving to new recent lows. Got another $3 or $4, probably about $3 down to support from the March low. 10-year Treasury yield. So the only economic report out today was the April housing starts and building permits. Housing starts came in just slightly below expectations, 1.4 million units. Actually 1.401, so 1,401,000 units. Expectations was 1,405,000 units. So it came in just below expectation. April building permits also came in below expectation. There we were looking for 1,430,000 units, and we came in at 1,416,000. So both came in slightly below expectation. Looking at the 10-year Treasury yield, really not a whole lot going on. Yesterday, you can see we did make a little bit of a move up. Still in this range, though. 327 downside, 365 upside. Up yesterday, down today. We're right back to where we were at the close on Monday. So 10-year Treasury yield, really not doing a whole lot. Look at the PPO sitting right on the center line. It's kind of the definition of no momentum. And that's where we stand right now. Moving on to talking technically, let's look at the S&P. S&P kind of looking a little bit like the 10-year Treasury yield, not really doing anything. We've now been sideways consolidating within a little more than 100 points, maybe 130 points. We've been in this range now for about 7 weeks. 4,050 downside, 4,179 upside. Which one breaks first? We're sitting in the middle. With options expiration, wouldn't be shocked to see it go down and test these lows. Sometime maybe later this week or even into the first half of next week. The NASDAQ 100, you can see here, nice uptrend, continues to roll to the upside. There's that August high I keep talking about. That's the big level. That's really a big level on the weekly chart. I mean, the daily chart come up. This was a big level. This was a big level. These were big levels. That's a big level. But on the weekly chart, that's a really big level. That's the key high to watch. This is the key low to watch. We've been trending higher, but we're still in the range. All right, I wanted to show you a little bit about what happened in the last 5 minutes yesterday. So let's look at the S&P 500. So there's your last 30 minutes. And by the way, this has been a lot different than what we've been seeing into the last, into the closes. I mean, here you can see the afternoon. This was 5 days ago. This would have been last Wednesday. Very strong afternoon. We were down at the low at 1:30, 1:40 in the afternoon. Here we were near the low just before 2 o'clock. We finished almost on the high. Here we go down all day long till right about 2 o'clock. And we nothing but buying from 2 to 4. A little bit choppier action on Monday, gapped up, moved down, had a pretty strong rally, moved down. And right around 2 o'clock, just before 2 o'clock, we strengthened again into the close. That's been a pattern I've talked about for many, 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 many months. Been seeing it. Wall Street's been accumulating. Call it what you want. I call it what I want. I call it accumulation. I think Wall Street's been accumulating while everybody's been selling. And we're going to find out the result of that as we finish out 2023 and move into 2024. I believe they're accumulating all the shares they can get because we're going higher. We'll see. But look at yesterday. It was a total about face. Last 30 minutes, this is a 10-minute chart. So these are the last 3 10-minute bars. Last 30 minutes, pretty big sell-off. Again, unlike anything we've seen the last week in terms of afternoon selling, especially into the close. The other thing I want you to just look at is as you look at the S&P over the last 5 days, we're honestly going nowhere. Yeah, there are lots of ups, lots of downs, blah, blah, blah. Afternoon strong, morning's a little weaker. Bottom line is we're sitting about where we were a week ago and not far off from where we were 7 weeks ago. I mean, it's, we're just consolidating. Now look at I want you to look at this chart and then look at the NASDAQ, the NDX, NASDAQ 100. See a little different move here? We're not sideways consolidating. The NASDAQ continues to push higher. Those large cap growth names have been driving it. Well, got hit a little bit though in the last 30 minutes yesterday. I know futures are up this morning. I didn't even talk about futures, but let me see where they are. Well, this would be as of 10 minutes ago. Yeah, I mean, Dow futures up 160, S&P futures up 18, NASDAQ futures up 36. So a little bit stronger on the Dow and the S&P. There's your more value oriented, a little bit weaker on the NASDAQ, more growth oriented. Is this the beginning of opposite George, yesterday afternoon and then into this morning? I don't know. We're going to find out, but I wouldn't be surprised based on the way options are set up. So I went through and I looked at the different sectors on the 5-day chart just to see on a percentage basis what happened in the last 30 minutes. And what I found out was the worst performer was actually real estate. So let's look at real estate. Real estate took another dive. It had already gone down. It's been a very weak group. You looked at, I showed you the S&P going sideways. Do you see this defensive group going down? If we look at Staples tried to go up. Now it's back down near the low of the week. Utilities, see this slope down. Healthcare, sloping down. Then you got XLK, sloping up. Of course, the last 30 minutes. See what happens as we go forward. XLY, pretty much sideways, kind of like Staples. And then XLC, sloping up from left to right. How about XLF? That more value oriented, mostly sideways, but a little bit of a slant to the downside there. XLI, breaking to a new 5-day low there. My point here is that coming into today and what we've been seeing in 2023 is money rotating toward growth. And I mean, if I look at a 1 month, let me show you, this is the IWF IWD over the last month. Actually, let's pull this up with S&P first. And let's get rid of the candlesticks, solid line. And then down below, we'll do a price relative. And so what I'll start off with is IWF IWD. That's large cap growth versus large cap value. And don't need the volume. Let's just see what this looks like. All right, so here's your S&P. Not really doing anything, right? From a month ago, we're actually down just a little bit. Do you see what's going on with large cap growth versus large cap value? Money's rotating into growth. Everyone thinking the stock market's going to go down because of an upcoming recession, Wall Street completely disagrees with you. They'll gladly take your growth shares. Because if we were heading into a recession, especially a potentially nasty one, I'd be getting rid of all my growth stocks. That's not what Wall Street's doing. There's your large cap growth versus large cap value. And even as bad as mid caps have been, let's change this. And let's look at the Dow Jones US growth mid cap versus value mid cap. Let's pull that up. How's this going on? S&P again, going down. Look at growth versus value. And what's even better, let's look at the mid cap. We'll just pull up the mid cap index. So mid cap stocks are going down. But look what's going on in the relationship between growth and value. Again, this is what you're not going to hear in the media. They're not going to be talking about this. They're going to talk about how mid caps and small caps are underperforming. How many people are talking about the fact that money is rotating heavily into mid-cap growth versus mid-cap value? Let's take it a step further. Want to look at small caps? Let's come down here. Take a look at the small cap growth versus small cap value. Small caps getting hit last 30 days. And look what's been going on since the beginning of May. Everything moving into growth. You remember the chart I've been showing? The seasonality chart I keep showing about the IWF. Well, I could probably look at any of the growth. But if I pull up IWF, IWD, and I go back the last, well, let's go back 11 years because that's the secular bull market. But remember, you add up all these coming across. That's the average outperformance on an annual basis. IWF, large cap growth versus large cap value. And then you look at what's taken place May to August. The entire growth outperformance versus value since 2013, the entire outperformance of growth takes place in the 4 months we're in right now, May through August. So now that you've seen that, does it surprise you that literally on May 1st, money starts rotating into growth versus value? All you hear is go away in May. How about move into growth in May? That doesn't rhyme. Can't go with that one. We need something clever. We need some clickbait. Again, nobody talks about it. I'm going to talk about it because I think it's important. All right, chart of the day. And I tell you what, we're going to do the chart of the day and then we're going to wrap up. We're going to leave early today. That'll be a first. If I finish this show at Earnings Beats before 9:30, it'll be the first time ever, I'm pretty sure. But anyway, let's, for those of you who like the chart of the day, I just want to mention a couple things. First, if you scroll down, if you go over to earningsbeats.com, scroll down, you can sign up for our free newsletter. Great way to get to know us. Type in your name, email address, hit that subscribe button, and you're done. No credit card required. You can unsubscribe at any time. We'd love to have you as part of our community. It also gets you into any of our free events that we do. This will get you into any of our free events. So we will send out room instructions to anybody who is on our free Earnings Beats Digest newsletter. And in addition, you're going to get 3 newsletters a week, Monday, Wednesday, Friday, 2 paragraphs in a chart. That's how I describe it. Very easy, simple read. We try to get it out sometime around 8:30, about an hour before the market opens. Sometimes it's a little bit later because of me. Usually it's my fault because I get the newsletter done, the article done a little late. Sometimes I have something else going. I can't get to it. But usually it's out by about 8:30. That's what we strive for. All right. The other thing I want to mention, we start our spring special tomorrow. It is by far the best deal that you're going to get throughout the year. It's a great, an absolutely great time to jump in, because if you like our service, you can take us up on our best deal of the year. So you get a 30-day no cost trial if you sign up. You do have to give credit card in order for us to get you set up in our system. But after 29 days, we'll tell you that your 30-day trial is about to expire. We're not going to just let it go by the wayside and hope that you don't notice. We only want you if you want to be a member. I think you're going to love our service. There's a reason why the majority of our subscribers stick with us. Obviously, part of it is the calls that we made over the last few years. But we do a lot of research for our members and set them up to just trade more efficiently and smarter. Check this out, 30-day no-cost trial. And here's the deal. If over the next, I don't know how long the spring special goes, maybe 10 days or something like that. But if you take us up on the trial offer and during the next 10 days, you decide, hey, I'm interested, I like this service, you can then sign up and extend your membership. The extension starts at the end of your trial. You don't lose your trial. So you can try it, and over the next 10 days, make a decision if you want to take us up on our spring special, which will save you a lot of money. A lot of money. So great time to try us out. Anyway, just wanted to mention that. All right, I want to talk today, chart of the day, Datadog. We had our Max Payne session last night. I just want to show you quickly. I showed our members how you can get over here and get this information and how you set the filters. But what I want to show you is Datadog finished yesterday at about $88. I think it was $88.07 at the close. Anyway, if you look at all the in-the-money calls, these are all the calls. These are all the strike prices. Anything at $88 or below is in the money on the call side. So all of these open interest calls, all the way down to 88, you can add them up if you want as we go down. There are a ton of in-the-money calls down to 88. All of these above are all in the money. How about on the put side? In order for them to be in the money on the put side, you got to be above 88. Well, I'm only counting maybe 1,000 total. And yet below 88, look at all these, 2,300 there. There's 1,000, 1,400 here, another 1,000 there, 8,300 at 70, 513 at 67, another 4,000 at 65. There's a ton of in-the-money call premium. Does that guarantee us the price goes lower? No. Does it mean it's riskier to be long? Yes. Right now, I would not be long this stock. It doesn't mean it can't go higher. Market makers protect themselves with when the stock's going up and people are buying calls, market makers are on the other side selling calls. The way they protect themselves is buying the stock. So they actually add on to the strength in the stock as it goes higher because they're buying the stock, but they're selling the call. When you get into option expiration, they've been making money on the stock that they've owned. They've been losing on the calls, but they're making money on the stock. They're fine. They haven't lost any money. But what they can do is sell their stock, book their profit, and start shorting the stock to take it back down. And then what happens to all this premium that they have to pay out? It starts going down. It's a win on the long side, a win on the short side, and they start reducing the premium they have to pay. Win, win, win. Now let's look at the chart. Because I'm looking at Datadog and I see a major resistance level coming across here right at $88 to $89, maybe 90. Looks like we got up here to about 90 a couple of times. Let's call it 88 to 90. Major resistance. Lots of in-the-money calls. Which way is it going to go? I mean, it could break out. But if I'm looking at this stock, thinking about taking a position, knowing what I know about options, zero chance I'll buy it. I don't care if it breaks out. It's all about analyzing and assessing risk. It's the risk that keeps me away from the stock. Now, if it pulls back $5 or $10, then now I'm starting to get a little bit more interested in the stock. But in the meantime, right now, with it sitting against resistance, all this in the money call premium, no chance. All right. It just turned 9:30. We're going to wrap up, but let me pull up, see if we've got the opening price here yet. Yep. So we got the Dow. Everything's up about 0.4 to 0.5%. So we got a decent start to the day. Let's see if this holds not only today, but throughout the rest of this week and into early part of next week. Because if the bears, let me tell you something. You got market makers on your side right now. If you can't get the market down over the next 5 days, I wish you the best of luck. Because I think this is an opportunity for the market to pull back 2-3%. And whether it does or not, I guess we'll all find out together. Anyhow, that's all I got for today. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. Of course, that one will be recorded. But all you have to do is come in here. You don't have to be a member of Stock Charts. Just click on Stock Charts TV right at 9 o'clock, and you'll get my next show. Everybody have a great day. Happy trading.